Welcome to vTalkInsight, Risk Sentiment Daily for January 16, 2026. Global markets are leaning risk on, with equities grinding higher and volatility contained, but under the surface investors are quietly building hedges against policy and geopolitical shocks. Let's unpack how that mix of optimism and caution is shaping today's opportunity set and risk premia. Across assets, the prevailing tone is risk-on but hedged. Broad equity indices are advancing, and the volatility index is in the mid-teens, consistent with constructive sentiment rather than stress. Yet investors are layering in protection, particularly around macro policy and geopolitical tails. On the positive side, multiple signals point to healthy risk appetite. Market commentary highlights strong optimism, with expectations for equities to extend their rally and a mild pro-risk stance supported by robust profit momentum, ample liquidity, and still accommodative central bank conditions. Offsetting that, concern is building around persistent inflation, political pressure on the Federal Reserve, and elevated geopolitical tensions from the Middle East to the Arctic. Safe haven demand in assets like gold, structural worries over fiscal deficits, and a persistent focus on Fed independence show that while investors are engaged on the upside, they remain very attuned to tail risks. A key bullish force is the broadening equity rally and rotation. Small caps, value, and cyclicals are increasingly taking the baton from mega-cap growth and the largest AI names. The Russell 2000 has outpaced the S&P for multiple sessions, marking its strongest relative streak since 2017. Commentary points to small and mid-cap equities, industrials, commodities, and even housing-related stocks as emerging leadership. Forward earnings estimates for small caps are turning up relative to large caps, and valuations are seen as attractive, especially versus stretched large cap multiples. Outside the U.S., emerging markets are rallying on improving credit ratings and orthodox policy frameworks. Large allocators are increasingly uneasy with concentrated AI and data center exposure, which is encouraging diversification toward value, regionals, and international markets. That said, pockets such as large universal banks are already viewed as fully valued, and signs of complacency are emerging. The takeaway is that breadth is improving, but leadership is rotating rather than risk simply rising indiscriminately. Another powerful bullish driver is the AI-driven capex and earnings boom. Taiwan's semiconductor has laid out a notably strong outlook, projecting revenue growth close to 30% and lifting capital spending to as much as $56 billion, well above prior expectations. Management indicates capacity is effectively sold out through December 31, 2026. This surge is rippling across the semiconductor complex. Suppliers such as ASML are hitting record highs on expectations for robust tool demand, and the broader chip industry is projected to reach around $1 trillion in annual sales on the back of AI infrastructure build-out. Platform leaders like NVIDIA and diversified players such as Broadcom are cited as key beneficiaries. Beyond hardware, AI adoption metrics remain strong, with accelerating user engagement and revenues across leading AI firms and earnings estimates being revised higher not only for AI champions, but for the broader market. Still, management at major foundries warns about the risk of misallocated capex, and investors are wary of concentration around a few platforms and even specific firms like OpenAI. For now, though, AI remains a central engine of the pro-risk narrative. Supportive policy, liquidity, and credit conditions are reinforcing risk appetite. Market views are divided on the exact path, but there is a growing cluster of expectations for 2 Federal Reserve rate cuts in the second half of the year, even as officials stress the need for evidence that inflation is heading back toward target. Several commentaries suggest the Fed is likely to keep policy on hold or ease, even if inflation ticks up temporarily, which investors read as supportive for risk assets. Options markets are pricing a wide range of outcomes, from a small hike to multiple cuts, but with little apparent concern about significantly higher rates. Corporate credit spreads are expected to stay tight or even compress further. At the same time, capital markets are vibrant. Major banks report record trading and investment banking revenues, with strong deal pipelines and expectations of accelerating M&A and underwriting activity into 2026 and 2027. Add in ongoing fiscal support, deregulation in some areas, and robust AI-related investment, and the near-term backdrop for liquidity and refinancing looks favorable, even if longer-term fiscal risks are flagged elsewhere. Set against these tailwinds, Fed independence and policy uncertainty risks are a major bearish driver. There is rising concern over political interference in monetary policy, including public criticism of Chair Powell, discussions about the president's authority to remove Fed governors, and even investigations into past decisions. Many observers frame central bank autonomy as essential to maintaining price stability and maximum employment. They warn that erosion of independence could either lock in higher inflation or force sharply higher rates if credibility is lost. Markets already grapple with persistent service inflation, talk of a de facto 2.5% to 3% inflation norm, and divided expectations ranging from no cuts to several cuts. Layered on top of that, large and persistent U.S. fiscal deficits, with debt projected to climb from around $30 to $40 trillion, add to worries about term premia and the sustainability of low long-end yields. Investors are increasingly focused on curve shape, real yields, and the potential for policy mistakes. The net effect is a higher policy risk premium across U.S. assets and a bias toward greater volatility in rates and currencies. Elevated geopolitical and energy security risks remain another key headwind. Tensions around Iran, from internal unrest and extreme inflation to periodic confrontations with the U.S., keep the risk of sudden escalation alive. Disruptions in Red Sea shipping and active enforcement against shadow oil fleets add another layer of uncertainty for energy and freight markets. Beyond the Middle East, attention is turning to the Arctic and North Atlantic. NATO deployments to Greenland and disputes over sovereignty are complicating U.S.-EU relations and could delay trade agreements. Commentary also flags concerns about U.S. military overextension, with commitments stretching from Venezuela to the Asia-Pacific, which may reduce deterrence and raise the probability of surprise shocks. In the near term, oil prices have actually fallen as rhetoric softened and some geopolitical risk premium bled out of crude and precious metals, underscoring how headline-driven these markets can be. However, the backdrop of structural oversupply in oil coexists with fragile choke points and depleted strategic reserves. That mix keeps geopolitical risk firmly on investors' dashboards even as day-to-day pricing swings. The final major headwind is a cluster of valuation excesses and financial stability concerns. Large-cap U.S. equities, including some universal banks, are widely described as stretched after strong rallies, with much of the favorable macro backdrop already embedded in prices. In commodities, silver has doubled in a short period, with commentators warning about a potentially volatile endgame phase. In credit, the explosive growth of private lending vehicles is being highlighted as a potential systemic risk, with questions over how closely this area is being monitored. While bank credit quality is currently solid, charge-offs are expected to normalize higher from very low levels. Proposals to cap credit card interest rates also raise concerns about profitability, credit access, and even recession risks if miscalibrated. Within technology, there is growing dispersion, with only select AI names driving outsized returns while many peers lag. Market participants warn that if a central node like OpenAI were to fail, the impact on AI-driven valuations and data center investment could reverberate widely. These vulnerabilities mean that even in a broadly risk-on tape, shocks could travel quickly through the financial system. To sum up, markets are entering today with a broadly risk-on posture, supported by a widening equity rally, an exceptionally strong AI-driven capex cycle, and still supportive policy and credit conditions. Offsetting that constructive core are serious tail risks around Federal Reserve independence, geopolitics, and pockets of valuation and financial stability stress. Investors are embracing upside in small caps, cyclicals, semiconductors, and emerging markets, while simultaneously paying close attention to policy headlines, energy choke points, and signs of froth in select assets. How this balance evolves will shape risk premia and cross-asset correlations into the coming weeks. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.